Hi, this is Anand Varadarajan here, and I'm here to talk to you about the myths that exist about direct equity investing. There are a lot of people who talk to us and tell us that direct equity investing is risky and direct equity investing is not giving returns, and we could commit a lot of mistakes and stuff like that. So what we are trying to bring to the table is that we want to tell you that direct equity investing is going to be efficient if it is done in a very formal and a disciplined way. How are people investing today? Today, people make investments based on some news. They hear from some relatives, they hear about some stock doing well, they hear about some company performing well or badly, and they make decisions based on this in a very informal manner. So what we're trying to bring to the table is to tell you that if the direct equity investing is done in a formal and disciplined way, it is definitely bound to yield good results. Having spoken about all the problems that arise with direct equity investing which is happening currently, I would like to now bring in Dr. Vikas Gupta to demystify the aspects of direct equity investing. So Dr. Gupta, is there a more disciplined and sensible way of investing in direct equities?
See, Anand, that's a very good question of how people do direct investing. There are a couple of ways how people get initiated into direct investing. Typically, this will happen once there has been some performance in the markets and markets have started in the bull run.
Right.
That is when people start thinking about equities, and then the thing comes out that either some of their friends or family or brother-in-law, the famous brother-in-law, is the person who suggests that they get into equities.
Right.
Typically in India, it's also seen that IPOs, when a PSU IPO is coming, is when a lot of retail investors get into the investing. And then of course there is sales pressures from the various brokers trying to enlist members. So all of these different ways of getting into markets are there. And once you are in the markets, you start looking at the media and newspapers and start following some companies or hear names of the companies on the front pages, and you think maybe it's a good thing to investigate further.
True.
Or possibly some people just go and buy it.
Yeah.
Now these kind of behavior has a lot of pitfalls associated with it. As you can imagine, nobody would have thought whether equities is right for them in the first place.
Sure.
So the first step according to us is that you do your own risk profiling, either yourself or with a trusted advisor, and then place yourself into a conservative, aggressive or moderate or various other risk profiles. Once you understand that you should have some exposure to equities and how much exposure you can take and for what duration, that's when you start saying, okay, now what strategy do I use it with? Now typically this is the piece which is missing in direct equity investing. People don't have a set strategy. They just buy some stocks as recommended by their brother-in-law or the broker.
Sure.
Right? So the pitfall there is you've not decided how much allocation you want to do.
Absolutely.
You've not decided how many stocks you want to have in that allocation.
Absolutely.
You've not decided the level of diversification, and you've not decided your holding period. What will trigger a buy, what will trigger a sell, what will you monitor? You don't know how you're performing against the market or who should you compare against. So these are all the pitfalls.
So Vikas, having heard all of this, I really feel that there is a real need for a disciplined way of investing. Is there something that you have on offer?
Yeah, see, as I mentioned, there has to be few things you have to set beforehand.
Right.
And you have to understand, you have to pick a strategy. Now what Arthveda has done is we have come out with the Smart Alpha series of indices, and the differentiation of these indices as compared to any other strategies you will come across is we are able to tell you, like a product specifications, we are able to tell you what is the long-term return of these strategies, what are the worst case scenarios for a 5-year holding period, what is the best case scenario for a 5-year holding period, what are the typical or median or average returns you can expect,
right.
What is the maximum capital loss, what are the chances of preserving your capital over various 1, 3, 5 and 10-year holding periods, what are the chances of outperforming the index over these periods. So you have a full control and understanding of these strategies.
Sure.
Based on your risk profile, you can pick the appropriate strategy from yourself, and now you should understand that you can't invest in an index.
Correct.
So you need to take these index strategies and you need to go to your broker, get a Samarth account, which is a self and actively managed, automatically rebalancing, trading and holding account.
Sure.
So what does that mean? That means that you as the direct investor is going to manage your account yourself. You're going to manage it actively, although not with a large churn. You're going to automatically rebalance as the index strategy switches from certain constituents to other constituents, and you have to use the trading and holding in that demat account. So this is what you need. So you need smart alpha strategies combined with some.
So because that's amazing, and it's really heartwarming to see that by bringing in discipline into direct equities, we can really drive a lot of value and make our investments worthwhile. So folks, as all of you all would have seen, Arthveda and the smart alpha strategies out of Arthveda and the indices that are being promoted by Arthveda are definitely going to add a lot of value to your investing into direct equities. Get out of your Samarth account, go speak to your broker and get into the value investing way.